Welcome to the deep dive. Our mission today is an exhaustive and, I think, critical evaluation of a cornerstone of the American economy.
Oh,
We're talking about Comcast Corporation, trading as CMCSA.
right.
This is a company that so many of us see as the ultimate media and connectivity conglomerate, but it's currently facing what a lot of investors believe is an existential crisis.
Yeah.
So we're diving deep into the investment thesis to really understand this profound uncertainty.
And that framing is, I think, precise. When we look at Comcast, we see a company that, still dominates the market. It's the largest U.S. broadband provider. We're talking a massive footprint of 31.4 million domestic subscribers as of the third quarter of 2025.
Which is just a staggering number.
It's huge. And by any historical measure, this should be a premium asset. It should be a robust, predictable cash flow engine. But the market is signaling deep distress.
And the numbers tell that story so clearly. The stock is what, hovering around $28 right now?
There, yeah.
That's a drop of nearly 35% from its 2021 highs. But then you look at, the sell-side analysis. Figures like Morningstar's $44 fair value estimate.
And you see a colossal disconnect.
A huge one.
Exactly. This isn't just market volatility. This is the market pricing in fear, real fear, the fear that the core business is fundamentally broken. So our deep dive is focused entirely on unpacking that fear. We need to figure out if this intense competitive pressure on their core broadband base, is it a temporary cyclical dip?
Something that a tech upgrade like DOCSIS 4.0 and maybe some better pricing can solve.
Right. Or is it a signal of a permanent secular decline in the pricing power that the cable duopoly has enjoyed for decades? The central question, really, for any potential investor listening to this is whether their other assets, the diversified pieces, media, theme parks, that growing wireless segment, can they truly compensate for the pressure on the pipes?
So before we get into the weeds on that, let's just nail down the scale. You mentioned they're diversified, but how reliant are they still on those pipes? What kind of revenue are we talking about?
We're talking about massive, massive scale. Comcast generated well over $30 billion in quarterly revenue in 2025.
$30 billion in a single quarter.
Yes. But here's the critical ratio, the number you have to keep in your head for this entire conversation. The connectivity and platforms segment.
So that's the broadband, the wireless, the actual cable TV.
All of that. That segment contributes roughly 65% of that total $30 billion in revenue. But even more critically, it delivers over 85% of the company's consolidated EBITDA.
85%. So that's the profit engine.
That is the engine. It's the profit measure that fuels their dividend, their buybacks, everything. So if the connectivity engine sputters, the consequences are immediate and they're far-reaching for the whole organization. And of course, for the investment thesis.
Okay, let's unpack this then. Before all the recent volatility and this competitive storm we're talking about, Comcast built a truly formidable business model. It was based on a network advantage that was, the envy of the entire industry. They weren't born a giant, right? They were built through very strategic, very aggressive expansion. What were those key historical moves that cemented their dominance?
It was really a story of scale, first achieved through acquisition, and then followed by some very clever capital allocation. So while they were founded way back in 1963, the real transformation happened in the early 2000s. The definitive move was the 2002 acquisition of AT&T Broadband.
And that wasn't just another small deal.
Oh, no, this wasn't a bolt-on. This instantly doubled their subscriber base. It gave them the dominant national footprint in major U.S. markets overnight.
And crucially, that footprint wasn't just old copper wire. It was the hybrid fiber coax network, the HFC network. That's the real reason they had that massive cost advantage for decades, isn't it?
Absolutely. The HFC network became their foundational economic moat. They use this network to market the classic triple play bundle, video, internet, phone.
The bundle everyone remembers getting mailers for constantly.
Constantly. But the competitive edge was this technological cost efficiency. Through these iterative upgrades to the data over cable service interface specification.
DOCSIS.
Right, DOCSIS. They could dramatically increase broadband speeds. They were hitting gigabit service by the late 2010s using the same basic infrastructure.
Walk me through the mechanics of that cost efficiency. Just how cheap was it compared to what, say, Verizon or AT&T were trying to do back then?
The difference was just staggering. It's hard to overstate. Competitors who were relying on those old copper DSL lines, they faced an insurmountable obstacle. To offer competitive speeds, they had to physically rip out the copper and lay brand new, incredibly expensive fiber optic lines.
Which costs what?
Hundreds, sometimes even thousands of dollars per home pass. Per home. But Comcast, they could achieve those same gigabit speeds just by leveraging the existing coax cable that was already run to the home.
Right.
Their incremental upgrade cost, moving to a standard like DOCSIS 3.1, it was estimated to be as low as $9 per home pass.
$9.
$9 versus, let's say, $900.
That's not a competition. That's a blowout.
It's not. And that massive margin allowed them to just dominate broadband subscriber growth all through the 2000s and 2010s. That's where they earned that narrow economic moat based on efficient scale. And by 2018, the transition was complete. Broadband revenue officially surpassed video revenue. The internet was the business.
Here's where it gets really interesting for me, though. They recognize that the cable TV business, the video part of that triple play, was facing this huge secular decline. Cord cutting was real. So they made this transformative leap into content and media to diversify, to integrate vertically.
That strategic pivot was, at the time, seen as masterful. The 2011 acquisition of majority control of NBC Universal. That was a massive bet on vertical integration. It brought in these incredibly valuable assets, broadcast and cable networks, film studios like Universal Pictures, and very importantly, the theme parks.
And the idea was this would offset the cord-cutting losses.
It did. It gave them huge new streams of advertising revenue, and it gave them tremendous bargaining power for content rights. They weren't just the distributor anymore. They owned the content.
And they didn't stop in the U.S. They went international with Stry.
Correct. The 2018 acquisition of Sky Pluric for around $40 billion that expanded their reach deep into European pay TV and broadband. So the historical financial story was this incredibly powerful, virtuous cycle. You have massive cash flow from the low-cost HFC network,
Right.
which leads to stable, high cable EBITDA margins, in the 40% range.
Which is just fantastic for a utility-like business.
Fantastic. And that robust free cash flow, it funded everything. It funded network upgrades, aggressive capital returns. They initiated a dividend in 2008 and billions in annual share buybacks. They were the definition of a blue-chip stalwart. They seemed immune to major competitive shocks.
But something fundamental changed around 2021. When did this glorious run hit these, structural headwinds?
The competitive landscape shifted dramatically, and it happened almost simultaneously. The years 2020 to 2021 were really the pivot point, and while the pandemic temporarily masked some of the problems, Comcast added 1.9 million internet customers in 2020 alone.
Everyone was working from home, schooling from home. They needed better internet.
Everyone did, but the real storm arrived by mid-2021.
The famous twin threats that we hear about in every single telecom report now.
Exactly. The first threat was the accelerated fiber overbuild. Companies like AT&T and Frontier. They basically decided the old DSL network was strategically dead.
About time.
Right. And they committed billions to full-scale fiber deployment, targeting something like 30 million fiber locations by the middle of 2025. And fiber, it offers superior upload speeds, better reliability. It was attacking Comcast from the high-performance end.
Okay, so that's the high end. What about the low end?
The second threat was fixed wireless access, or FWA. This was primarily from T-Mobile and Verizon. They used their excess 5G spectrum capacity to offer cheap, simple home internet.
The little boxes you just plug in?
Just plug it in. It was targeting the value-conscious segment, and it worked. By 2025, FWA had accumulated a combined 13 million customers, a lot of whom were stolen directly from cable providers like Comcast.
So you have the low-end customer being poached by cheap FWA and the high-end, performance-seeking customer migrating to new fiber.
Yeah.
What was the immediate financial consequence of this double-barreled assault?
It had a shock to the system, a real shock. In the second quarter of 2022, Comcast reported its first ever quarterly net broadband subscriber loss ever. And investors, they instantly panicked. They saw the end of the lucrative, comfortable cable duopoly. The stock cratered by 28% that year. And this forced management into a very painful, very expensive strategic pivot. They had to transition immediately from a business model built on easy annual price increases to one built on defense, on value, on retention. They even publicly admitted they had been slow to respond to the pace of this competitive change. The old way of doing business was simply over.
So if that old model is dead, what does the Comcast business model look like today? They're trying to balance this utility-like connectivity, the legacy cash cow, with this volatile, super capital-intensive entertainment business. How do those two pieces fit together now?
It's a very delicate hybrid model today, and understanding the financial composition is absolutely key. If we use the Q3 2025 data again, that connectivity and platforms segment accounts for about 65% of revenue, or $20.2 billion quarterly. This is the financial engine room.
And within that, broadband is still the crown jewel.
It's the anchor. It generates over $6 billion quarterly in very high margin revenue. The rest of that segment includes video, which we know is in secular decline. They lost 257,000 video subs in that one quarter.
Wow.
And of course, Xfinity Mobile.
And then you've got the high-risk, high-reward segment.
That's content and experiences. That's NBC Universal and Sky. This is where the growth optionality, the exciting stuff lies. The theme parks division has been an exceptional performer.
They've been on a tear.
An absolute tear. Revenue was up 19% in Q3 2025, benefiting from all that post-pandemic travel and, importantly, the intellectual property synergy. Then you have Peacock streaming, which has reached 41 million paid subscribers.
Which is a big number, but it came at a huge cost.
A huge cost. This is expensive growth. Peacock incurred multi-billion-dollar losses through 2024 as they just invested aggressively to gain that scale.
So if the connectivity segment is generating 85% of the EBITDA, what does adding that big media component do to the overall financial profile of the company?
It creates significant margin dilution. That's the key takeaway. Historically, those pure cable operations, they ran at close to a 40% EBITDA margin, which is fantastic.
Right.
But once you combine that with the lower margin, higher volatility media assets, the studios, the networks, and especially that huge streaming investment, the consolidated corporate EBITDA margin drops significantly. It gets closer to 20%.
So the content part provides diversification, some growth upside,
Yeah.
but it inherently lowers the overall profitability profile of the whole company compared to, say, a pure-play peer like Charter.
Exactly. That's the trade-off.
So let's talk about the new bundle then. Bundling 2.0, the triple play is history. What is the new retention tool they're using to keep customers from leaving?
The new strategy is all about convergence. It's internet plus mobile plus Peacock. The goal is to maximize customer lifetime value and stickiness. They are willing to accept lower ARPU average revenue per user in the short term to achieve that.
And Xfinity Mobile is the key weapon here.
It's the primary defensive weapon. They now have 8.9 million lines, and it's priced incredibly aggressively, often at or near break-even.
So it's not a profit center.
Not at all. Its true value isn't profit generation, it's retention. A customer who is taking broadband and mobile and streaming from you, they face vastly higher switching costs than someone who is just taking broadband. It locks them into the ecosystem.
And the Peacock integration is designed to reinforce this platform effect.
Precisely. They offer Peacock Premium for free to their higher-tier broadband customers. This is super low-cost marketing for Peacock, and it increases the perceived utility of the overall internet subscription. This whole vertically integrated content flywheel allows them to leverage their intellectual property, whether it's the huge success of Mario movie or Jurassic World, across theatrical releases, their streaming platform, and then again at their highly profitable theme park attractions.
But we have to be critical of that vertical integration. It's not all upside. What is the primary drawback of being so complex?
The drawback is that complexity and the increased competitive exposure that comes with it. By owning NBC Universal, Comcast is forced to compete against two completely different sets of formidable rivals.
So on one side, you have the telcos.
The AT&Ts and Verizons of the world in connectivity.
And on the other, the media giants.
Exactly. The Disneys, the Netflixes, the Warner Brothers Discoveries of the world in content. And that content business is cyclical. It's incredibly capital intensive. It requires constant reinvention and these huge capital outlays for original programming. It's nothing like the relatively stable, utility-like nature of the broadband cash cow.
And finally, on the geographic front, you mentioned Sky's performance in Europe has been pretty lukewarm, which really just confirms that the fate of Comcast is predominantly tied to the high ARPU dynamics of the U.S. market.
That's the big inference, I think. While Sky offers some international diversification, its gradual subscriber losses in European pay TV mean that Comcast's strategic focus, its financial health, it's all overwhelmingly tied to its ability to defend that U.S. broadband base. This whole hybrid model is about using the stable U.S. cash flow to finance the defensive war on the ground. That's DOCSIS 4.0 and Xfinity Mobile. and simultaneously fund the high-risk, high-growth optionality in theme parks and streaming.
We've established that the narrow economic moat, the one built on those HFC cost advantages, is now under direct siege.
Yeah.
We have fiber coming in from the top with superior performance and FWA coming in from the bottom with superior pricing. The duopoly is dissolving. So how strong are Comcast's technological and competitive defenses against these twin threats?
The defense mechanism is it's multifaceted, but it really has to start with technology. Let's look at the fiber threat first. Comcast estimates that approximately 55% of its massive 60 million home footprint now faces a fiber competitor.
It's more than half.
More than half. And that number is growing by 3 to 5% every single year. And fiber's key advantage is symmetrical speeds, meaning the upload speeds match the download speeds, and just overall reliability.
And that's where Comcast's big DOCSIS 4.0 upgrade comes into play. Walk us through how that is supposed to neutralize fiber's main advantage.
DOCSIS 4.0 is, well, you could call it the Hail Mary pass for the HFC network. Comcast is aggressively trialing and beginning the rollout of this next-generation standard. It promises to deliver symmetrical multi-gig speeds. That means upload and download speeds are essentially equal, which is the key differentiator that fiber currently enjoys.
So how does it work?
The genius of DOCSIS 4.0 is that it achieves this without needing to replace the core coax line to the home. It leverages the existing network. This allows Comcast to achieve technical parity with fiber at a fraction of the capital cost, which maintains their historical capital expenditure advantage. If they execute this flawlessly, they buy themselves several more years of high competitiveness.
Okay, but let's challenge one of management's core assumptions here. The long-term moat, as you said, relies on fiber competitors maintaining rational pricing. But if AT&T or Frontier have invested billions in new fiber, their primary motivation might shift from maximizing immediate ROI to just maximizing market share, right? Just to utilize that sunk capital. Couldn't that trigger sustained destructive price wars that break that whole rational pricing assumption?
That is the ultimate risk to the moat, and you've hit on it. If capital is deployed irrationally, meaning competitors just undercut Comcast aggressively to steal customers no matter the cost, then Comcast's margin advantage is immediately eroded. However, management points to evidence from 2025 that suggests rationality is, for now, still prevailing. Even as the fiber players gained market share, they were still able to raise their average revenue per user by about 5%.
So they're still focused on profits.
It suggests they are aiming for returns, not just raw market share, which gives Comcast room to compete on value. But you are absolutely right. If the competition turns irrational, all bets are off.
All right, now let's turn to the other threat. FWA, Comcast, and a lot of analysts express skepticism that FWA from T-Mobile and Verizon can scale indefinitely. Why is that? Explain the technical trade-offs.
The skepticism really stems from the finite capacity of wireless spectrum. FWA uses the exact same 5G network spectrum that mobile phones use. So as T-Mobile and Verizon sign up more and more FWA customers, they're targeting 13 million combined by 2025, they start hitting physical network limits, especially in densely populated areas or during peak usage times.
And when the network gets congested, what happens to the FWA service?
When network congestion occurs, the wireless carriers have to prioritize their premium mobile phone customers. That's their core business. This means FWA speeds can slow down dramatically. The entire FWA moat relies on price. It's as low as $25 a month, but if it sacrifices reliability or speed during high demand hours, the high usage and reliability sensitive customers,
The most profitable ones.
exactly, the most profitable ones, they'll quickly churn back to a wired solution, whether that's fiber or cable. The entire defense here relies on FWA proving to be a short-term, low-end solution, not a long-term replacement for wired broadband.
Okay, so beyond the network technology, the mobile convergence strategy, Xfinity Mobile, is the next layer of the moat. How is Comcast improving its own MVNO economics to make that viable long-term?
Right, so Xfinity Mobile isn't just about using Verizon's network. It's about managing their costs and increasing that customer stickiness. Comcast is a mobile virtual network operator, an MVNO, which just means it pays wholesale rates to Verizon to use its cell towers. To reduce that massive wholesale cost, Comcast is strategically deploying its own small cell networks using something called CBRS spectrum.
What is CBRS spectrum, and why is that deployment so critical for them?
CBRS stands for the Citizens Broadband Radio Service. It's basically a publicly shared mid-band spectrum that Comcast can use to build its own localized 5G networks, especially in high high-traffic areas like downtowns or even in dense residential neighborhoods.
So it's like their own little private cell network.
That's a great way to think about it. The goal is to offload 20% or more of Xfinity Mobile data traffic onto their own infrastructure. Every gigabyte they offload costs them pennies instead of the dollars they have to pay Verizon. And this is crucial because their MVNO contract with Verizon is up for renewal in 2026. If they haven't substantially improved their wireless economics by then, Verizon could demand significantly higher wholesale rates, which would jeopardize the whole convergence defense.
So the scale advantage they have allows them to fund DOCSIS 4.0, deploy their own CBRS networks, and absorb this short-term pricing pain. This is the difference between a giant like CMCSA and a smaller regional cable provider, correct?
Absolutely. The massive scale is the ultimate defense mechanism. We see evidence that the stickiness is working. Xfinity Mobile has 8.9 million lines, and while their competitor Charter currently has a higher attach rate, 21% of their internet subs take mobile compared to Comcast's 14%. Comcast is catching up very fast, adding 400,000 to 500,000 lines per quarter. The narrow moat is stressed, there's no doubt, but Comcast's ability to invest in this dual defense tech parity with fiber and price and stickiness parity with FWA through convergence is what maintains it.
This intense competitive environment has forced a major strategic pivot. It's so clear that the old playbook of just, annual price increases is shelved probably forever. What specific actions is management taking right now to stabilize the bleeding? What are the quantifiable short-term costs of this defensive strategy?
Management has fully embraced what we can call the convergence playbook, and it fundamentally prioritizes retention and stabilizing that subscriber base over any kind of immediate ARPU growth. The most direct evidence of this is the pricing reset. Comcast deliberately chose to hold its broadband prices flat throughout 2024 and 2025, and they moved customers to these simplified contract-free plans. They're competing on value now, not just speed.
And that sacrifice of ARPU has an immediate, painful impact on their core profit engine. Can you quantify that hit for us?
It is painful, but they see it as necessary. Goldman Sachs estimated that this pricing reset would result in Comcast's broadband EBITDA declining by approximately 4% year over year for several quarters between 2025 and 2026. And the Q3 2025 data confirmed this, showing a 3.7% drop in connectivity EBITDA. Management has been very upfront about this, forecasting zero broadband ARPU growth in 2026.
Zero. That's a huge strategic admission.
It is. They are willing to absorb significant earnings compression now to stop the subscriber bleeding. The way they try to mitigate this loss of ARPU is through the Xfinity One Convergence Bundle. This is their central retention tool. They're offering perks like one free mobile line and a free Peacock Premium subscription, specifically for customers on their high-tier internet service plans.
So they are sacrificing immediate mobile revenue and absorbing the cost of Peacock, with the hope of making it up on the back end through higher customer lifetime value.
Precisely. It's a deferred monetization strategy. The cost of a free mobile line is significant, and giving Peacock away obviously sacrifices streaming subscription revenue. But the calculation is simple. If they can prevent churn, the long-term benefit of a sticky, multi-product customer far outweighs that short-term cost. The strategy is to stabilize the base now and then upsell them later, perhaps converting those free mobile lines to paid lines, or migrating them to higher-tier broadband by 2026 or 2027.
And beyond the pricing, we talked about the necessity of DOCSIS 4.0. How is that being executed on the ground?
Network modernization is their top capital priority right now. They are ramping up DOCSIS 4.0 trials very rapidly, aiming for a broad launch of symmetrical multi-gig speeds by 2025. And this isn't just about headline speed. It's about eliminating fiber's key technical advantage, those superior upload speeds that you need for modern applications, like cloud storage and high-resolution video conferencing. Management is betting heavily that parity in performance, combined with their value pricing, will be enough to protect the base.
And are also addressing the old industry nemesis, customer service.
That's a crucial strategic pillar because customer frustration so often drives switching. Comcast is investing heavily in customer experience, expanding 2047 USA-based support, and adopting customer-friendly policies, like automatic outage credits for service downtimes over 2 hours.
Trying to shed that old reputation.
Exactly. Yeah. Their long-term goal is to reduce the switching inertia that's caused by poor service and thereby reinforce retention.
Let's shift to the content side of the house. How has the NBC Universal strategy been streamlined to support this core mission?
The content strategy is now all about focus and maximizing cash. The major symbolic move here was selling their 1/3 stake in Hulu back to Disney in 2023 and 2024. That move fetched a large cash infusion, at least $8.6 billion, and it allowed them to narrow their streaming focus entirely onto Peacock, which, as we said, has 41 million paid subscribers. And the goal for Peacock is incredibly aggressive. It's to shift from a massive loss generator, we're talking multi-billions lost between 2022 and 2024, to approaching break-even by 2025 or 2026. To do this, they're bidding aggressively for critical sports rights, like potential NBA streaming packages, to bolster Peacock's appeal and make it an indispensable platform. So this content strategy now directly serves the core connectivity business by providing a vital perk for that convergence bundle.
The inference here seems to be that management is exhibiting a prudent, measured defense. They're prioritizing operational execution and stabilizing the base over any kind of new empire building.
Absolutely. The strategy is a long-term retention playbook. Management is willing to absorb this profit hit now to ensure they stabilize the subscriber base before the competition rationalizes and dissect 4.0 is fully deployed. The fact that they have what they call a high bar for M&A, despite holding a large cash position, confirms they are focused on execution and maintaining financial discipline, especially given the existing complexity and debt load from Sky.
Now we turn to leadership, stability, and the financial foundation. Comcast has very stable leadership under the Roberts family, but was that very stability also responsible for the slow reaction to FWA that we discussed earlier?
That is the perennial debate with any founder-led or founder-family-led company. Chairman and CEO Brian L. Roberts, who is the son of the founder, he retains executive control through a dual-class share structure. It gives him roughly 33% of the voting power. The benefit of that is continuity and a long-term strategic view. That's evidenced by this willingness to sacrifice short-term ARPU to defend the moat. The drawback, however, is the potential for complacency. Some analysts argue that the leadership, being so comfortable in that cable duopoly for so long, underestimated the speed and the efficacy of the FWA threat.
But they've taken steps to address that.
They have. The 2022 promotion of their longtime CFO, Mike Cavanaugh, to president and then later to co-CEO in 2023, that positions a very strong financial operator as the eventual successor. This is seen as an attempt to inject sharper financial discipline and faster response times into the organization.
We also have to acknowledge the complexity of managing such a diverse portfolio, which was highlighted by that abrupt leadership change at NBCU in 2023.
That's right. The swift exit of NBC Universal CEO Jeff Shell due to misconduct forced a rapid restructuring of the media arm. And while the company handled the transition smoothly, it really underscored the management challenges inherent in overseeing such disparate businesses, from theme parks to cable operations to streaming content, each of which requires a completely different management skill set.
Let's pivot to the most crucial factor here, the balance sheet. Is Comcast financially resilient enough to fund this massive defensive maneuver and the ongoing expensive Peacock investment?
The financial health is, I think, the biggest competitive advantage they possess right now. Comcast maintains their target leverage is around 2.4 times net debt to EBITDA, and while their consolidated leverage is currently a bit higher, around 3.0x, due largely to the Sky acquisition.
That's still pretty moderate.
It's very moderate, especially when you compare it to peers like Charter, which runs its leverage closer to 4.5 times. This financial discipline gives them enormous flexibility.
You mentioned free cash flow, FCF, earlier. This is the ultimate proof point of their core business durability. So how strong is that FCF machine, and what's the outlook?
The FCF machine is robust, and it's set for a significant expansion. Comcast generated $12.6 billion in free cash flow in 2024, and management guided for a strong 20% rise in 2025. But crucially, that FCF expansion is expected to accelerate significantly after 2025, even if revenue growth remains muted.
Why does FCF spike even when revenue growth is slow? This is a key insight we need to really unpack.
It's entirely due to capital expenditure moderation. Management has provided very clear guidance that the capital expenditures are peaking in 2025. This peak is driven by two major, very expensive projects: the aggressive rollout of the dissect 4.0 infrastructure upgrades and the subsidized rural broadband expansion projects like RDOF.
So once those are done,
Once those large-scale network deployments are completed by late 2025 or early 2026, CapEx requirements will fall back toward their historical maintenance levels. This moderation in CapEx directly converts into higher FCF. Investors are looking for a clear line of sight to FCF expansion by 2027, regardless of immediate revenue pressure.
and how are they treating shareholders during this turbulent period? A lot of companies would cut the dividend.
Not Comcast. They're maintaining a strong commitment to a growing dividend.
They've increased it for 15 consecutive years, including a 7.4% hike in January 2025. The current dividend yield is substantial, around 4%. They're also opportunistic with share buybacks, deploying $3.5 billion in 2023. And this conservative yet steady capital return policy is further supported by that substantial cash infusion they expect from the Hulu stake sale, $8 to $10 billion, which provides even more flexibility for debt paydown or accelerated buybacks. The ultimate inference here is that financial strength is the core margin of safety for an investor. Their balance sheet is strong enough to fund the DOCSI's defense, absorb the profit hit from the pricing reset, and continue the costly Peacock investment without jeopardizing their investment grade rating or the dividend. They have the financial resilience to execute the turnaround.
We've thoroughly examined the risks and the defensive strategy. Now, let's look forward. If management successfully stabilizes the core broadband business, where does the future growth for a $30 billion quarterly revenue company actually come from? What are the key non-broadband levers Comcast is pulling?
The future growth narrative, I think, relies on 5 core levers. It's about moving beyond the stabilizing residential cable unit and leveraging their existing assets.
Okay, let's start with the most immediately successful adjacent lever, wireless.
Wireless acceleration is undeniable. Xfinity Mobile is still in hypergrowth mode. With 8.9 million lines, they are adding 400,000 to 500,000 lines every single quarter. Given their market share is still below 5% of the total U.S. wireless market, the subscriber runway is just vast, solely by converting their existing broadband customers. The goal is to maximize that attachment rate and reinforce the convergence mode.
And they're also growing on the enterprise side.
Yes, they're utilizing this connectivity expertise to grow Comcast business, moving into lucrative global SD-WAN and enterprise solutions, capitalizing on acquisitions like Mastergy in 2021. This taps into higher margin, very sticky corporate clients.
The second massive swing factor has to be Peacock. If it succeeds, it changes the perception of NBC Universal entirely.
Peacock monetization is a critical financial swing factor. With 41 million paid subscribers, the company is shifting from focusing purely on scale to focusing on profitability. The goal is to aggressively narrow those multi-billion-dollar losses they incurred in 2022 and 2023, and to approach break-even by 2025 or 2026. If Peacock successfully monetizes its large subscriber base and stabilizes, it immediately becomes a positive contributor to NBCU earnings, and it moves the needle significantly for the consolidated entity. The recent price increases that didn't drive massive churn show management has some emerging pricing power there.
I think the most tangible and highest margin growth driver, the one that is completely non-cyclical to telecom, is the theme parks division.
This is the hidden gem for investors, I think. The highly profitable Universal Parks and Resorts segment saw revenue growth of 19% in Q3 2025. And this segment is set for a massive step change with the opening of Epic Universe in Orlando in the summer of 2025.
Why is Epic Universe so important?
Oh, it's just another park, right?
It's a major multi-billion-dollar catalyst. New parks historically drive a step change in attendance and high-margin ancillary revenue, food, merchandise, premium tickets. This expansion is timed perfectly to coincide with the stabilization phase of the connectivity business, providing high-margin growth that is much less correlated to the U.S. housing or telecom cycles. It's expected to significantly boost NBCU earnings and overall cash flow after 2025. And finally, there's the expansion of the physical footprint into underserved areas.
That's the rural broadband expansion. Comcast is smartly utilizing government subsidies, specifically programs like RDOF, to extend its network to approximately 1 million additional rural homes by 2025. These are new markets where competition is minimal, allowing them to gain new subscribers and expand their footprint efficiently without having to fight pitched battles against fiber rivals.
Okay, now we need to balance this with a deeper dive into the most pressing risks to these growth initiatives.
There are 4 primary risks, and they're immediate and must be carefully monitored. First, competitive disruption is the central risk. If the assumptions management holds about FWA capacity limits or competitor rational pricing prove false, the modest subscriber attrition they're forecasting could accelerate dramatically. Losing 500,000 broadband users in the first 9 months of 2025 shows this is a tangible, immediate threat. If price wars become structural, margins could be permanently compressed below their historical norms.
And that MVNO contract is a massive ticking clock, especially given how much they rely on Xfinity Mobile for retention now.
That leads directly to the MVNO contract risk. Xfinity Mobile's success is predicated on favorable wholesale rates from Verizon. The 2026 renewal negotiations are a critical date. If the wireless incumbents decide that the cable companies are too dangerous as competitors and they demand much higher wholesale rates, Comcast's wireless economics could become unviable overnight. That would severely damage the convergence strategy and the stickiness moat. The third is execution risk. The entire defensive strategy, no contract plans, free mobile lines, the DOCSIS 4.0 rollout, it all requires flawless execution. Any billing missteps or delays in DOCSIS 4.0 implementation could drive customers to competitors who are already delivering symmetrical speeds. The market is extremely unforgiving right now.
And the regulatory and content risks, they never really go away.
No, they don't. Regulatory risk is always present for a company of Comcast's scale. The potential return of strict net neutrality regulations, maybe reclassifying broadband under Title II, could limit Comcast's ability to bundle services or differentiate traffic, constraining their converged business model. And finally, content risk. NBC Universal is exposed to cyclical film results and the possibility of losing key sports rights. If they fail to secure highly sought-after packages like the NBA streaming rights, Peacock's appeal and its path to break even would be severely hampered, hurting the overall content moat.
So we have a diversified giant dealing with these existential threats to its core profit engine, but simultaneously using its immense financial strength to invest heavily in future growth. How does the market weigh all of this complexity, and what does the valuation tell us about investor expectations today?
The valuation is the clearest sign of the current market pessimism. At the current price of around $28 per share, Comcast is trading at a very depressed multiple of approximately 8 times 2025 estimated earnings. Even more striking, its valuation is only about 5.5 times forward EBITDA.
Compared to Morningstar's $44 fair value estimate, which implies a valuation closer to 7 times EV to EBITDA, that is a vast discount. What is the market pricing in at 5.5 times EBITDA?
That deep pessimism implies that the market is expecting zero or even negative long-term growth and a permanent compression of their margins. It's pricing the business as if the current competitive turmoil is the new permanent state of affairs. The fact that the stock is down 20% year-to-date 2025 means investors believe the defensive strategy will fail. But this deep undervaluation creates a significant margin of safety. While you're waiting for the competitive environment to stabilize, you are paid that substantial growing dividend yield of approximately 4%. Furthermore, the company's strong financial health and the conviction shown by insiders, like the cable CEO Dave Watson buying substantial amounts of stock, that suggests that management believes the current price does not reflect the underlying asset value.
So let's discuss the outlook scenario. What is the most realistic path to recovery that validates that $44 fair value?
The immediate outlook is near-term turbulence, and I think that lasts through 2026. We have to expect continued muted broadband revenue growth and slight pressure on connectivity EBITDA as that pricing reset takes hold. Continued modest broadband subscriber losses will likely occur. This is the low point of the competitive cycle, and investors really need patience.
When can we expect the benefits of this big defensive strategy to start showing up in the numbers?
The medium-term recovery should begin to materialize around 2026 to 2027. This is when DOCSIS 4.0 should be fully deployed, neutralizing fiber speed advantage. It's when FWA capacity limits could potentially start driving some high-usage customers back to wired. And it's when churn should begin to normalize, giving management the ability to reintroduce mild price increases or successfully upsell premium bundles.
What specific events could trigger a re-rating of the stock and move it toward that $44 target? What should people be watching for?
There are 4 key catalysts we're watching closely. First, stabilization of broadband. If Comcast can report smaller subscriber losses than expected, or maybe even return to net additions by 2027, that would be huge. Second, faster than expected Peacock break-even. If Peacock achieves profitability ahead of its 2026 target, it instantly removes a major earnings drag. Third is the FCF expansion. As capital expenditures moderate post-2025, the resulting surge in free cash flow will fuel greater shareholder returns. And fourth, strategic clarity on the Hulu proceeds. If that $8 to $10 billion cash infusion is used efficiently for an accelerated, accretive share buyback program, it will substantially reduce the share count and boost EPS. The overall investment thesis here is purely a contrarian value play. If Comcast simply achieves 0 to low single-digit growth with margins stabilizing, which is still a pretty conservative performance outlook, the stock could easily re-rate by 50% toward Morningstar's fair value. They have the financial firepower and the diversified assets to execute the turnaround, but it is a massive bet on management's ability to execute this complex convergence strategy flawlessly, all under intense competitive fire.
time to synthesize the findings. What are the 3 core insights we should carry away from this comprehensive deep dive into Comcast?
First, the core profit engine is undergoing a painful reset, but the defense is geared for the long haul. Comcast's core narrow moat is severely eroded by fiber and FWA, forcing a strategic sacrifice of short-term profits, that zero broadband ARPU growth forecasted for 2026 to protect the crucial subscriber base. The success of this defense relies entirely on the successful and timely rollout of CMCSA 4.0 and the monetization of the Xfinity mobile convergence strategy. It all requires sustained financial strength.
Second, diversification provides crucial resilience and near-term growth catalysts. Unlike pure-play connectivity peers, Comcast's substantial content and experiences segments, particularly NBC Universal and Universal Parks, provide a vital buffer. The massive catalyst of the Epic universe opening in 2025 is set to drive immediate, high-margin revenue growth that is insulated from telecom competitive pressures, stabilizing the consolidated results during this connectivity downturn.
And third, the stock price is in disaster, creating a compelling value opportunity. Comcast stock is trading at a deep discount, approximately 5.5 times forward EBITDA, which treats the business as if it were in terminal decline. However, its strong balance sheet, its moderate leverage, and a clear line of sight to significant FCF expansion post-2025 provides the financial means to execute the turnaround. It provides a strong margin of safety, and it suggests significant potential upside if the competitive environment normalizes.
That is a phenomenal deep dive into the complexity of CMCSA. So a closing thought for you to consider. Comcast is betting that the current competitive frenzy is cyclical, not secular. If they're wrong, if fiber overbuild is relentless and if FWA capacity just keeps expanding, is there a point where the Roberts family sacrifices part of the media empire, perhaps spinning off NBCU, to generate the war chest needed to defend the connectivity core? Or is the complexity of the integrated content and connectivity model now their defining strength that must be maintained at all costs? The answer to that will define Comcast's next decade.